getting into, you want to be able to get that tenant base. And that's what makes multifamily very advantageous. Now, going off of this a little bit, giving you guys a little bonus, a little extra. Right now, in my opinion, the multifamily space is overpriced. It's dangerously overpriced. Things don't make sense. And you know when they don't make sense because you'll put 20% down and the property's still not cash flowing. Or if it is, it's barely cash flowing. So you want to be very, very careful. And if we are dealing with clients that want to buy this stuff, you have to educate them and let them know what the risks are. So does anybody kind of know why the values go up and down in single family homes? Supply and demand, right? So the easiest example is if my house is here and your house is over here, and wow, these are really bad pictures. And then your house sells for $300K. Well, it's assumed my house is pretty close to this price, right? Maybe not 300. I don't know. I got to see the inside, but it's kind of that's kind of the general rule, right? It's kind of that. Now, if your house is in Palm Harbor and somebody else's house is in, I don't know, St. Pete Beach, you can't really use that comp. It doesn't really matter. It's the land that we're looking at. It costs the same amount of money for material, building, all that is the same. It's land that makes the value different. Land in New York is different than land here. It's just the way it is. It may cost you the same exact everything for rebar, piping, whatever it is. So you cannot use this example in multifamily in the commercial space at all, because these properties are all based on income. We are in, and you'll constantly hear this term, NOI. We are in an income-driven marketplace, and that's what it is. Your buyer wants to know, what do I come home with? Somebody buying a house very rarely will say, well, no, they might ask, like, hey, what do you think we can sell for in 10 years? Or how much can I rent this thing out for? Most of the time, they want to live there, right? It doesn't make sense for someone to buy a 20-unit building and live in one of the units. It's kind of, maybe it does happen, I should say, but it's not likely. So if you're looking at this income from a standpoint of maybe it's your very first investment, the more you make, the more you're going to buy. Because if you're making $50,000 a year, now you're making $100,000, now you're going to reinvest the profits. Highly unlikely someone's going to keep buying houses just to buy them, unless they're renting them out, right? Unless you're buying a house and you're renting it, there's no reason for you to buy another house if your house is fine, unless you're going to upgrade. But the odds are not going to happen this quickly. People that are buying multifamily property, they tend to buy quicker. It sounds funny, but they'll buy maybe 2 properties a year. Maybe they'll buy 10 in 3 years. They'll upgrade, they'll sell, they'll do 1031, they'll move their money around, they'll do things like that. So it's different in that standpoint that we're constantly looking for income on that particular property. Now, I did a video on how you can get the value of any multifamily property in 5 minutes. If you're interested, anybody, I'll send it to you, or I can, or you can just Google it, check it out. It's definitely there. So you want to keep your eyes on how much money is coming in. So let's suppose, give you guys a little bit of a tip here. So let's say you're talking to somebody and they say, you know what, we want to buy 2 units or 3 units or whatever the number is, but whatever number it is. The reason they're buying that is to make money on their investment, right? They want to invest and they want to get things up and going and they want cash to come in. Nobody would just say, hey, I want to house all these people and I want to be the greatest landlord on the planet. It doesn't happen. So when you hear that, when you hear an investor, when you hear an investment take place, your responsibility is, okay, well, how much money are you trying to make? And it's a serious question. Like what you'll constantly hear cap rate. heard cap rate even before? Okay, so your cap rate, I don't like the way that looks. That's better. All right, so your cap rate is just your return on the property, not for the investor, on the property. It's very, very important. Meaning, and I'm gonna simplify it for you right now, and I kinda wanna test where your investment heads are. So let's suppose I'm buying a property, it's $1 million, and I want a 10% return. Net income at the end of the day. Anybody know how much money I'm looking for?
100,000.
You're looking for 100 grand. You're looking for 100K. So you want 100K equals a 10% cap rate on $1 million property. Now, just so you guys know, 10% is not common. I'm using 10 so we don't get lost. If I start saying 7.65, we're all gonna need calculators. So, on $1 million property, if you want a 10% return, you want 100 grand. So if you're dealing with someone who wants to buy 5 units, 4 units, whatever the number is, and they tell you, hey, I want a 10% return on my money, whatever that number is, maybe it's 7%, 10, whatever it is, you have to start working backwards. Because you know, if you want to get them this, you need to find something that's worth this, and that nets 100 grand. So, they're not interested in what their expenses are. They're not interested in the management fees. They're not interested in the, any of that stuff. There's only one number that does not apply to the cap rate, and that's why the cap rate is your property return, right? The number that does not, anybody know? Your mortgage. The reason why this is not a return for the investor is because the mortgage is not calculated in this. The formula assumes you own the property clean and clear. So once you put debt on it, it changes the playing field a little bit. So you have to be careful, and you want to be a little not invasive, but you want to understand your client's situation. And maybe not word these questions this way, but how much money do you have? Where's it coming from? What's, kind of get in their head and figure out what it is. You don't want to ask about their personal life and everything too much, but you need to know, hey, are these funds borrowed? Because if you're borrowing the money at 2% and we can get you 10%, well, there's a nice good arbitrage and we can cover the delta pretty easily. Now at the same time, if we're borrowing the money 8 or 9%, well, we need to know, because that may not work out very well.